Good evening, one and all present over here.
Good evening, sir.
Good evening, sir.
Yeah, good evening. Good evening. Can we start or people are joining? Only I can see 19 participants. Please remind me to start so that I'll share the PPT.
We will start, sir.
Okay. One.
Those who are willing will join.
They will judge. Okay. Okay. Fine. Let me share. Is it visible to all of you?
Yes, sir, it is visible.
Thank you very much. So, in continuation to our last class discussion, we were discussing about the topic on multinational enterprise and national institutions. So, we were discussing about the national institutions, their role, and we understood that the purpose of comparing, I was talking to the last class, between the MNE, multinational enterprise, or we call MNCs, and the National Institute. Generally, it helps us to understand how global business strategies interact with local rules, norms, and governance, revealing tensions, adaptations, and opportunity for both the sides. There we discuss the concept of understanding the institutional influence. So last class I was showing few of the institutional influence institutions, reputed institutions, like all government bodies. They follow a cultural norms, legal system to set the environment in which these MNCs were operating. So today I would like to discuss this national financial institutions with the basic concepts on the Exim Bank and ECGC, or we call the Export Credit Guarantee Corporations. So, in continuation to our last discussion, the national institutions, today we would like to focus on the national financial institutions with specific preference to Exim Bank and Export Credit Guarantee Corporations. Okay, so friends, let's discuss the Export Import Bank, in short we call Exim Bank, is a government-owned financial institutions established with an object to promote and finance India's international trade. So there was an act established in 1981, Export Import Bank of India Act, or we call it Exim Bank Act, is a premier export financial institution of our country. The act, it was enacted in 1981 and set up in 1982.
No.
Anything for me? Okay, no issue.
No, sir, nothing for you.
अच्छा, okay, ठीक है.
For us. A disturbance for us.
Okay, no issue. So that act, it was launched with an objective uh, to support or to enhance exports from India, but to incorporate the country's foreign trade and investment overall economic growth. So this Exim Bank, it plays a very pivotal role, a key role in supporting exporters, facilitating overseas investments, and extending lines of credit to foreign entities. Right? Supporting the exporters mostly. And we'll not go in details about how it is formulated and all. We'll focus on the core functions of this Exim Bank. One is the export credit. Okay. So when we talk about export credit, it provides a pre-shipment and post-shipment finance to Indian exporters. So this is a very typical terms we used, pre-shipment. Okay. So what is this purpose of the pre-shipment, or we called, there is one word we called packing credit or pre-shipment finance or packing credit also we call. The purpose is to fund the working capital needs before goods are shipped. Before goods are shipped. I hope you must be knowing in the September our last shipment, it was made to US with the old tariff rate, not with the new. So somehow for that the exporters look for better working capital support. So when we talk about export credit, the first point it provides the pre-shipment, which talk about funding the working capital needs before goods are shipped. 1, 2. Then post-shipment finance, the purpose is to bridge the gap between the shipment and the payment realization. It takes some time to generate the payment. This is the first, the core functioning of the Exim Bank. Next, what we call LOCs or line of credits. Line of credits are financial instruments extended by India primarily through the Exim Bank. What for? To foreign goods and institutions, enabling them to purchase Indian goods and services on deferred payment terms. So this LOC offers a deferred credit to foreign governments and institutions to purchase the Indian goods and services. What is this deferred payment? Very simply, buying now and paying later. This is what the concept we call deferred payment. Okay. So this
Sir,
also,
again, sir, please.
Yes, sir.
Sir, again, please tell, sir, not understanding.
The line of credit you are talking about.
Yes.
Yeah. This line of credit, these are all we call financial instrument. Okay. So this speaks about offers deferred credit. Okay. What is this deferred credit? Concept deferred credit or deferred payment. I am deferring. I'm not paying now. I'm deferring. What does it mean? Buying now and paying later stage. Is it clear? What is this deferred credit or deferred payment?
Buying from foreign country, sir.
Buying from anybody. Buying now and paying later. If I would like to purchase some, I'll give you an example. If I am buying some, called some electronics item, right? Some electronics item, not paying now. That means I am availing the credit facility and would like to pay later stage. Here in this transaction, there is one more concept we also discuss in financial services subject, where we talk two important terms. This is out of the context I'm saying. That is what we call factoring and forfeiting. I'm slightly diverting this. Factoring and forfeiting. What does it mean? This deferred credit or deferred payment. Factoring is a concept where the business sells its account receivable. Sir, I hope you are familiar with this term, all of you, dear friends. Accounts receivables, or we call debtors. Accounts payable, or we call creditors. In financial accounting, you must have studied. So when there is an accounts receivable, that means there is an invoice raised to the customer. The customer has purchased one television from me on credit basis. That means I am raising an invoice to him and he will pay me later stage. But here my money is going to be blocked if I am going to transact directly to the customer on a credit basis, if it is a deferred payment basis. There is one arrangement, it has been made with the concept that a third party, there is an involvement of a third party. I am selling, you are buying, third party involved at a discount received, he will pay me immediately the amount which I have done a transaction. Is it clear to say to all of you, sir, friends?
Yes, sir.
I am
Yes, sir.
selling. I'm a sales. I'm having a say electronic shop. I'm selling refrigerator, televisions, ovens, and all. So you purchase on credit basis. Now you are not paying. So if these things happens, because I have to follow the credit sales. If I am not doing credit sales, my volume of business will not increase, and my competitors, I'll be facing a lot of challenges. That is the reason why we follow that EMI, equated monthly installment basis. So many facilities are there. Hypothecation we discuss. Another concept we call factoring. That means banks are generally the factor. International transaction, we consider it is a factoring or forfeiting. Bank or any financial institution, he will immediately pay me the money. I will raise the invoice to the client, to you, as well as to the bank. Next, the bank and my client relationship will establish for the recovery of the money. I will be free from that. In the process, my money is not going to be blocked, and I will have a better idea, and my working capital is not going to be suffer. I'll buy more products and would like to do a better business volume. In international standard, we call this is forfeiting. It is the purchase of medium and long-term receivables from an expert by forfeit. A forfeit considered generally banks, because large volumes are involved with this. So this line of credit offers offers deferred credit to the foreign investments and institutions to purchase Indian goods. These are second functions so far as the Exim Bank is concerned. Third, we see the overseas investment finance. It is a specialized funding mechanism offered by institutions like Exim Bank to support Indian companies invest in foreign markets. So support Indian companies investing in abroad or in the foreign market. It enables the business, the companies to acquire strategic assets access to new market, diversify operation, and enhance global competitions. This is the third functions which is being supported by the Exim Bank. Then comes the project exports. Facilitates Indian firms in executing infrastructure and industrial project overseas. This project exports enable Indian companies to undertake infrastructure and industrial projects abroad by providing financial, technical, and policy support through Exim Bank. And there is one more we call PC. That's what we call Project Export Promotion Council of India, PEPC, through Exim Bank, and another is the Project Exports Promotion Council of India, we call PEPC. So this is what the fourth function to the Exim Bank. We are discussing about the national financial institution in relevance to the Exim Bank and ECGC. Fifth is the technology and product development. Exim Bank supports finances, research and development, and innovation for export-oriented businesses. Okay. So through this process, this Exim Bank extended the LOC to over 60 countries across Africa, Asia, Latin America, and many other places. This is what the global reach, and it operates international branches, including one in the London. So this is what we talk about national financial institution so far as the relevance to the Exim Bank of India. Second, would like to discuss the Export Credit Guarantee Corporation. It is a government-owned enterprise that provides export credit insurance to Indian exporters and banks, helping reduce the risk associated with international trade. This is badly needed, sir, so far as the insurance is concerned, because there is all possibility to the risk might comes, and we have to reduce or eliminate the risk which is associated with the international trade. These are the few strategic importance speaks about the ECGC. It enhances confidence of exporters by mitigating the risk in global markets. Here, a few mathematics are there, how to calculate the risk. Generally, we used to calculate by using different models what should be the risk and how it is to be going to calculate. We are not required to go in details of that. So that gives a confidence in the minds of the exporter that your trade is insured. It supports MSME sector and large exporters, facilitates project exports, and it also helps Indian companies expand globally. These are the two important things which I am supposed to discuss yesterday, that speaks about national financial institutions. Okay. Then next area I would like to discuss the foreign sector of the developing economics. The foreign sector in developing economics, it plays a vital role in driving economic growth, technology transfer, and integration into global market. It includes trade, FDIs, foreign direct investments, remittance, and external aid. Let's look at the few of the important things. What is this foreign sectors? It refers to all economic transactions between a country and the rest of the world. In developing economies, this includes first the export and import. What does it mean? Trade in goods and services. I'd like to show you a few statistics on this. You can look at this export and import, trade in goods and services. This data is up to September 2025, and the source is Reserve Bank of India. Here you can see there are two areas we'd like to consider. One is merchandise, and second is the service sector. Totally, it comes both the combination. I hope all of you must be knowing what is merchandising. Merchandise, it refers to goods and services brought and sold, right? And or the merchandise trade we call import or export of goods. Here you can see merchandise export. Suppose if you take 2025, the export is very, very less than the import. And so far as service is concerned, export is much better, almost the double of the import. Conceptually, when we say that the export is more than the import, there is a trade surplus. That means more selling out there. There is a trade surplus. That's a good for the economic development of the country. If the imports, if we start importing more goods than the export, or the import is more than the export, then there is a concept we call trade deficit. There is a trade deficit. If you look at this statistics, if you look at this table, friends, you can see the service sector, we are doing excellent good than the merchandise, the goods and services transactions. You can see here this. And so far as the comparative, if you look at the total export and import, we are having a negative balance that speaks about trade deficit up to 2025. And if you compare to the 2024, the trade deficit, it's almost more than the double. It's almost double. So this is what the first point I wanted to discuss, how this foreign sectors, how it affects the economic transaction between the country and the rest of the world. Trade in goods and services is an important factor to boost the economic condition of the country. Second point, we'd like to discuss the FDIs, or foreign direct investment, which encourage more. India is looking for more FDIs because we expect that we will not have any risk in that, not volatility, because they will come, they will establish the factory, and would like to get more benefit out of this. It speaks about the investment by multinational companies. Let's look at this figure. You can look at this graph. The source is the Department of Promotion and Industry and International Trade, this DPIIT, and the statistics, the picture is in front of you till the financial year 2000. That speaks of April to June, right? That means it starts from April 2025 to 31st of March 2026. This is wonderful. You can see here there is a need of analysis. What happens in 2021? What happens with the 2021? In comparison 2021, what happens in 2025? Of course, 25 is well. So what happens to this FDI inflows in 2021? The highest $84.84 billion. Anybody, sir? Just guess, nothing. These are all statistical data. The data are available in RBI or DPIIT, all the data.
Due to uncertainty in India's growth story, the FDI has sluggish or reduced a little bit in compared to FY21.
Yes, there are many factors. When they look at India, they see the credential and credibility of the country, right? I was talking to one, the S&P Global rating from BBB minus to BBB. And they see the policies, the understanding the policies, and the geopolitical scenario of the country. Many factors they used to study and they go for investment. Support is also another factors, and everybody looks for that, how effective they can manage. Anyway, so these are the few statistics. Third points we'd like to discuss. First is the export and import. Second is the FDIs. Third is the remittance. What is the remittance? Money is sent home by citizens working abroad. Okay. So I have some statistics for this. By Indian working abroad scale, recording high of $135 billion in financial year 2025. The remittance sent back home by Indians working abroad have registered a 14% rise in the financial year 2024-25 to a record $135.46 billion, according to data which is compiled by the Reserve Bank of India. Wonderful statistics we got on this. Indian working abroad sent home a record of $129.4 billion in 2024, and the RBI said the inflows classify under private transactions accounted for more than the 10%. The number of Indians working overseas had tripled from 6.6 million in 1990 to 18.5 million in 2024, with its share in global migrants rising from 4.3% to over 6% during the same period. Of course, if these things happens, remittance will be there. Right, friends? So I was trying to giving this statistical information to support our discussion, how this export and import things are happening, how the FDIs are going on, what is the remittance things are going up. Fourth point, we'd like to have look to the foreign aids and the foreign loans. So this is what we talk of assistance from the international organizations, IMF, World Bank, or governments. Let's look at those next point. Okay. Foreign aids. India receives foreign aid from various sources, including the multinational institutions like World Bank, ADB, Asian Development Bank, and the bilateral patterns such as Japan, Germany, and United States. India received $2,831.24 million in foreign aids, a decrease from the previous year. This is the data of 2024 and 25. This aid is used for various sectors, including infrastructure, health, and disaster management also. India receives foreign loans from various sources, including multilateral institutions like World Bank, International Monetary Fund, foreign governments, and commercial banks. The country's external debt as of June 2025 was approximately $747.2 billion, primarily consisting of loan and was donated by USD denominated debt, according to the data of Reserve Bank of India. This is what we see our discussion, how the foreign sectors of the developing economies work. Next, we'd like to see the importance in developing economics. One is all this analysis we'd like to conclude here. There will be economic growth if FDI brings capital, infrastructure, and job creation. Export lead growth boost to GDP and foreign exchange reserve. In technological transfer, we see foreign firms introduce advanced technology and management practices. It helps local industries to become more competitive. Employment generation. Multinational enterprise create a direct and indirect job. Export industries often employ large segment of the populations. BOP, balance of payment support. This remittance and FDI help stabilize current account deficit. Foreign exchange earnings reduce reliance on external borrowings. And so far as infrastructure development is concerned, foreign investment often fund roads, ports, energy, and telecom projects. Any question after this, sir? You want to add some value? I'd be very happy to contribute.
So can you just have the last slide?
Last slide. Okay.
Yeah.
So these are what the importance in the developing economics. We look at economic growth, technology transfer, employment generation, balance of payment support, how to overcome the deficit, and the infrastructure.
The importance of what? Importance of?
In developing economies, what we have
importance
discussed.
in developing economies, but importance of what in developing economies?
Sorry?
Importance of
The topic we are discussing, the foreign sector of the developing economics.
okay, importance of foreign sector in developing economies.
Economics, yes. This is what I discussed.
GCEC, I think GCEC.
Yeah, GCEC.
GCEC, importance of GCEC in developing
In
economy.
developing economics, yes. Right, sir. Should I go for the next slide?
Sure, sir.
Thank you. Then comes the multicultural management. Multicultural management, the cross-border cultural management also. In HR, people used to discuss in details about that. Cross-border cultural management, they used to discuss in length on that. This multicultural management, this concept, it refers to the practice of leading and coordinating teams composed of individuals from diverse cultural background with the goal of fostering inclusions, collaboration, and productivity. Right. So when we like to see this practice of leading and coordinating team, it's composed of human resources, individuals from diverse cultural backgrounds with the goal of fostering inclusions, collaboration, and productivity. In management, we used to discuss this concept of productivity is the ratio of output and input subject to time and quality. Productivity. We use two terms, productivity and competencies. Productivity is the ratio of output and input subject to time and quality. 1. 2, we discuss competencies because in the collaborations and these things we see. This competency speaks about, there is a mathematical equation, that's what we call knowledge plus skill plus ability whole into attitude. Knowledge plus skill plus ability whole into attitude. That speaks about the leading the team and coordinating the members to achieve the goal and a better collaboration, and ultimately we would like to see the productivity. So the fostering inclusions means what? Actively creating an environment where all individuals feel respected, valued, and empowered to contribute regardless of their background, identity, or differences. That is number 1. So it's essential in today's globalized business environment where cross-border operations and diverse workforces are the norm. What is this multicultural management? I'd like to have some extended to this meaning. It involves understanding, respecting, and leveraging cultural differences in the workplace. Understanding, respecting and leveraging cultural differences. Leveraging cultural differences, what does it mean? It means turning variations in cultural norms, values, ethics, and behavior into a business advantage. Objective is to connect diverse customers. So recognizing the cultural norms and values, adopting communication style, managing diverse expectations and behaviors, and creating inclusive policies and practices. This approach helps organizations avoid misunderstanding, reduce conflict, and build stronger and more connective teams. Next is like to discuss international market and instrument. International
Sir, can you
financial.
just throw the last slide, sir? Just a
Yeah.
minute.
Yeah.
Sorry.
No issue.
Okay, sir.
Right. Okay. Then comes international market and the instruments. International financial markets are global platforms where financial assets are traded across the borders, and they offer wide range of instruments like Eurobonds, treasury bills, and certificate of deposit, we call CD and CP, to facilitate global investment, trade, and capital flows. So international financial market is a global platform. The financial assets, which speaks about the Eurobond, treasury bill, certificate, T-bills in India, we consider it as a treasury bill, like 91 days treasury bill, 182 treasury bill. This is being generated through the Reserve Bank of India. And a certificate of deposit, all these things being processed through the RBI in Indian context to facilitate the global.
Sir, can you please explain what is treasury bill and certificate of deposit?
Sir, you will have one paper, right? There is a paper we call financial services. Okay, where these entire things are going to be discussed. Okay, I'll discuss, no issue. So like, government bond, sir, government bond. Government used to issue bonds. Like that,
Sure.
RBI also issue short-term loans, right? RBI issue treasury bills. Technically, we call T-bills, right? With a less interest rate, but highly secured. If you calculate the beta, generally we discuss in the CAPM model, capital asset price model, where we see the risk factor. Here the risk factor would be 0. But when the risk is 0, of course, the return would be very negligible for 3.5%, 4% like that. But risk percentage is 0. So this is on the day basis, it is being calculated 91 days, 182 days. This has been done with a bulk amount, and bankers and financial institutions generally invest in this for the short-term purpose. They have a surplus fund where they will keep. They used to invest in the treasury bill, so that they will suddenly, within the 91 days, they will get back their benefit of.
Actually, this is given to banks, sir.
Yeah, mostly banks and financial institutions, not for the general public. The volume is big, very big.
Okay.
If I'll discuss that, it will. Okay. Any other free time, I'll discuss those things.
And certificate of deposits are like this. You tell.
Same. There is a certificate deposit, CD, CP also, certificate of participation also. So many things are there. It is being issued by the Reserve Bank of India. Eurobond, Eurobond?
No, sir.
Okay. I'll tell you what is this Eurobond. A Eurobond is a type of bond. Generally, it is issued in a currency other than the one of the country where it is issued. Confused. I repeat once again. A Eurobond is a type of bond issued in a currency other than the one of the country where it is issued. For example, a bond issued in US dollar in India would be a Eurobond. A bond issued in US dollar in India would be a Eurobond. Right, sir?
Yes.
So this is what we go. I'm not going to in details about that. It's not required, of course. We will have a separate paper where a lot of discussion will be made in financial service. There is a financial instrument services and market. There is a special 100-mark paper is there. Anyway, so this is what we talk about the international market and the instrument. There are different types. One is foreign exchange market, or we call forex. This facilitate currency trading between the countries. Largest and most liquid financial market in globally, forex market. Instrument like your spot, forward, and currency swap. There is a derivative instrument. I hope you must be knowing about forward, future, swap, option. All these things are traded. I hope all of you must be knowing about derivative tradings. Is a financial instrument traded on the basis of underlying assets. The price are determined on the basis of underlying assets. What is this underlying asset? Suppose I'll tell you one example. If the price of the milk increases, then the price of the cod automatically it will increase. Here, the price of the cod, the underlying asset is the price of the milk, right? So that's what we call derivative market that deals with the foreign exchange, forex. International capital market deals with the long-term funding through equity and debts, includes international stock exchange and bond market. Instruments such as Eurobond, foreign exchange bonds, global equities. I was going through one article 2 days back. I was going through an article as well as the print. It was there in a Mint. There is a newspaper that China has a substantial good amount of investment in US bond. So if he goes for the redemption of the bond, US will be in trouble. That's what there is one news it has come. You can go for better research on that. Then comes the international money market, focus on short-term borrowings and the lendings used by governments, corporations, banks for liquidity. Then instrument like treasury bill, certificate of deposit, commercial papers, we call CD, CP and all. Then derivative markets, it enables trading of financial contract based on underlying assets, used for hedging, speculations and arbitrage. Instrument like future, option and swap. Offshore financial market like operation outside the jurisdictions of the domestic regulations. Offers tax advantages and confidentiality. Instrument like offshore funds, private placement, structured notes, etc. Okay. So these are the different types. Each point you will have a.
Sir, actually we are. Hello.
Yeah. Please, I'm listening.
Hello.
Yeah.
एक्चुअली इसके ऊपर थोड़ा बताइए सर, हमको उतना नॉलेज नहीं है।
Sir, your
आप
voice
थोड़ा
is breaking.
उसको एक्सप्लेन करने से इट विल बी मोर बेटर, आई होप सो।
Yeah.
Like foreign exchange market, actually
Yeah.
who will.
Sir, actually
this you are explaining, na? On this slide, you please explain. You are going very fast. Actually, we are not up to of this background.
Acha, okay.
You please explain avail this facilities foreign exchange market, because we are not understanding anything. We are very fast and we are not of this background. That is the problem. And these wordings are also very tough. At least if you will something tell, we can write.
Okay. Sir, we started our discussion with the foreign exchange only. from the first
Okay,
module.
no problem.
Right?
But
No issue, sir, don't worry. I'll go in details. I'll not go a little bit faster. These are the certain things which I am giving additional, sir. Right? If you look
problem,
at,
sir. At least if
because
you
I expect
explain, then it will be.
Yeah, sir, I expect all of you are working executive. In that context, it is coming to the mind that I must give some additional information. Then subsequently, we will do a lot of research, because each point will have a lot of time it will take. Yes, sir. Don't worry, sir. I'll discuss in
This
details.
foreign exchange market and international cap.
Sir, your voice is breaking.
Hello. Okay, sir. You please continue, sir.
Okay.
Sir, can you
Sir.
just highlight this derivatives markets actually? This enabling trading of the financial contracts, that portion.
Sorry.
The derivatives market. Can you just explain a little bit more?
Yes.
Actually?
So that's what I said. Derivative market is basically based on the underlying asset. I given an example how the price of the cord is determined, how the price of the floor is determined. The price of the floor is determined on the basis of the price of the wheat. If the wheat price is increasing, then subsequently the floor price or the cord price, it will increase. This is what we call underlying assets, right? And in the forward,
just want to understand. It means you are telling that there are certain things is correlated. Once is getting higher, so another things is also getting higher. That's so you're telling,
yeah, of course, there is a proportionality related to each other. And what I'm trying to tell you that the underlying, what is the meaning of this underlying asset? So here, if you want to determine the price of the cord, the underlying asset is the milk, the price of the milk, right, sir? Okay, if you want to details of this,
sir. This next line it is there. Used for hedging, speculation, and arbitrage.
Yeah. I understand, sir.
What is that actually?
I should not use this. Is a big jargons. Speculations, right?
Yeah.
Arbitrage is also, buying from one market and selling in another. Okay, don't worry, sir. If you want in details also, I'll go for that. Let me go for as per your syllabus. I thought to give additional information so that you will do a lot of research. You have a 100-mark paper, derivative and risk management. All these paper are 100 marks each paper. Just for your information purpose, I am just explaining that these are the different types of things are available where the foreign exchange market is going to transact. Right, sir? All the multinational enterprises are going to be transact, or the multicultural management things are going to be happen. This is not supposed to be given here. I gave it with an objective that you will go through it and have some research.
No, that is a good synopsis, actually. This synopsis is very good. What I'm telling is, just after the class.
Actually, sir, can you please tell me what is the?
Actually, sir, if I'll go in each of the point, we are having a very limited classes. This generally we take 35 classes to complete this one paper. But this I have to complete within eight classes. That means 8 hours.
Okay, sir.
You are getting my limitations are there, sir.
Sir, can you please tell me?
So
sir,
actually, for these limitations, I am just giving these types and all. I am giving information so that you will go for a little bit research on this. You all are working executives, must be reading.
No, sir, other things all are understandable. Only these 1 or 2 points, which is exactly little bit critical. That's what I'm asking.
Okay. Don't worry, sir. I'll cover in the 4th model. You have international monetary and financial system. I'll cover this part in that area. Okay, don't worry, sir. I'll go in details of this. Anyway, don't worry, sir. We'll go for that. Okay, so in continuation to this financial instrument, we have the international financial instruments. These are the tools used in the global finance to facilitate the investment, trade, and risk management across the borders. This instrument, it helps government, corporations, and investors to raise capital, manage currency, and interest rate risk, and diversify the portfolio. Here, I'd like to explain some part. The diversification of portfolio is based on two important concepts. One is your systematic risk, another is your unsystematic risk, right, sir? So what are those systematic risks and unsystematic risks? When systematic risks are uncontrollable, we cannot control it, like your interest rate risk, it's beyond our control, like purchasing power risk, like inflation, like GDP, like currency transaction. We cannot control this. That is what we consider it is under the systematic risk. On systematic risk, it is diversifiable. What it considered two important points: business risk and the financial risk. Business risk, suppose there is a strike in a factory. Recently, I had been to Coca-Cola for one discussion, official discussion. I suddenly found the workers are on the strike, and for the short-term basis, the production hamper. But it can be they shut it out immediately within half an hour. So the risk which can be avoidable is considered as an unsystematic risk, and this is what we call diversifying the portfolio, not keeping in one. So portfolio, when it comes, that means don't keep all eggs in one basket. Keep it in the different portfolios. Suppose if you are investing equities only, there is a possibility of high risk. So if I go for the capital structure, my portfolio structure like this, 50-50% or 20-80% or 80-20%, 70-30% or 30-80. So 30-70, if I maintain this, then some part of the debt, some part of the equity, some part of the real estate, some part of the gold, right? So this multifactorial analysis we are going to diversify with an objective that my portfolio should run successfully. So this instrument generally helps to diversify the risk and to maintain a good business value. These are the key international financial instruments I have already discussed: the Eurobond, the foreign bonds. Eurobonds, I just said that a bond issued in, suppose in US dollar in India would be considered a Eurobond. Foreign bonds are there, bond issued in a domestic market by foreign entities. Global equities, stock of multinational companies traded on international exchange for objective is for the portfolio diversification. T-bills or treasury bills is a short-term government securities. It is very safe and can be liquidated so far as investment is concerned. Certificate of deposits, bank issued time deposit with fixed interest. This is for the purpose of short-term savings with guaranteed returns. Commercial papers, these are unsecured short-term corporate debts, and for the purpose quick funding for the corporations. Currency swap, this is a concept of exchange of principal and interest in different currencies. That's what we call the hedging of the risk. Of course, this is another terms it has come. Hedging of the risk. Hedge, you must be knowing about the hedge front also. And the operation and future, this is what we consider in the derivative market, right?
Sir, can you go before slide, sir?
This one?
Just previous slides.
Previous one. Is it okay, sir? So this is all about our discussion, sir, in relevance to the Unit 3, the multinational enterprise and national institutions. We have tried to cover major factors.
Sir.
And as you have said that you need to know in details about this type, foreign exchange, international capital market, the Nasdaq, Dow Jones, all these things. It has.
Sir, this sir, offshore finance market, what, sir?
Which one?
Offshore finance market.
Your voice is breaking, sir.
Offshore
Sir, he is
finance
asking
market.
offshore finance marketing.
Hello.
Sir, he is asking about offshore finance.
Acha, okay. Offshore financial services or marketing, these are financial activities like banking, fund management, insurance. Generally, these are provided by the financial institution in one country to non-resident that to another country. Banking, fund management, insurance. So these are we called offshore financial services. It is being provided by financial institutions in one country to non-resident of that country. And these services, these are often leverage jurisdictions with low taxes and very light regulations, and it attracts individuals and corporations seeking benefit such as tax avoidance, asset protection, portfolio diversification, etc.
They give to industry.
Yes.
But he should be non-resident of that country.
It's offered to non-resident in a foreign jurisdictions.
If they have industry in their country.
Yes. We call OFC, offshore financial centers.
Sir. Okay, sir.
I am open, sir, for any sort of discussion also. As the timing limitation is there with me. That is the reason why, because I have to go for another 2 models, which big models are there. So even though if you would like to discuss also, I am ready to explain you in details about that. But again, after completion, if you have any queries, please note down. We'll discuss in details about that. Like you asked about the foreign exchange things, hedging, or your arbitrage, portfolio diversifications. Portfolio diversification is a beautiful concept. We used to use that in a mutual fund industries, where we recommend investors to go for this not necessarily to one fund like small cap, large cap, or mid cap. We generally say that you need to go for multi-asset fund, multi-asset fund of fund, right? So there are some schemes like Nippon, SDFC, and all. We study those things. Yes, sir.
Thank you, sir.
Yeah. So portfolio diversification is badly needed for that. Even if you remember, 10 years back, those who have done investment in gold or gold bond, so they must have, or silver, those who have invested must have recovered a good amount of money. When silver, it has crossed 2 lakhs. Gold has almost crossed 1,30,000 also. So it's a good market. You need to study, or you need to understand what is that we are going to consider, and why these gold prices are increasing, why this silver price is increasing, how it affects the sentiment of the stock market, what is the pattern of this. So is a enormous discussion is badly needed. to understand that's what we call EIC, Economic, Industry and Company Analysis, and technically we call fundamental analysis of understanding the market, the foreign exchange reserves, so many things. So you have to go in details of that. Terminologies are, it will take some time to be familiar, but it's not that difficult. I was talking about factoring and forfeiting. That means the third party arrangement is there to support in the international market also. If anything goes wrong, insurance is a factor. These are the certain things we need to go in details to study how the exports are going to be to boost the economy of the country. Right, sir? Anything else you would like to discuss?
Sir, hello.
Yeah.
Sir,
So
actually,
there are 34 participants, sir. I only see very countable participation. I would like to learn from all of you also. If you have any additional
sir,
information,
no,
also.
what I'm telling, sir, we since we are all working executives now, we have a limited time. So these type of slides are very helpful for our study. Actually, can you just share
Yes,
this
yes.
all?
Sure,
after
sure,
the
sir.
classes?
100%. I would like to
Yeah.
ask Rasmi madam where to share this slides. I would like to share. If you go to the slides, then also discuss. Also, it will be a beneficial. I'll take the permission from Rasmi madam where to share these slides. After that, you can go to the details. Because these statistics which I have I've collected the statistics from various sources. Because seminars and all we used to attend, we collect the information. That's what very important. But each terminology is again, it's a matter of concern to understand. So once you come across, today we'll discuss, you go through the details of the books or the study material. You must have received the study material, sir. Anyway, or you refer any of the books.
Yes, study material is there, but all are not collected it.
Achha, okay. Anyway,
If you share, it will be better if you share
sure.
next
Yes,
class
sir.
subject at here during closing. We may go through. If you will get any time, we will go through. Then it will be better when you will taught us. You will taught us. It will be better for us.
Okay, fine. So I'll take the permission from Rasmi madam where to share this PPTs and all. I'm ready at 1, 2, 3 PPTs. I'll share it. Once I complete this fourth model, I'll go for that. But certainly I have to take permission from the authority to share it. I don't know where to share, which group and all. We have one group, I think all faculty members are there in the group.
Sir, you can send to Rasmi ma'am. He will share in.
Yeah, I'll do that. I think that would be better. I'll share to Rasmi madam. She will share to all the student groups. Right, sir?
Okay, sir. Good night, sir.
But is it okay to all of you the way I'm going?
Yes, sir.
Yeah,
Yes,
sir.
sir. It is fine.
It's absolutely fine, sir.
So we
Yeah,
don't have any other
that's why I'm
option
telling.
also.
Class is very good.
Okay. Thank you, sir. Thank you very much, sir. See you day after tomorrow in the same
Thank you,
class.
sir. Thank you.
Start
Good
with
night.
the fourth module, International Monetary Fund. Right, sir. Thank you very much. Good night.
Yeah, thank you, sir. Good night.
Good night. Good night.
Yeah, good night.
Good night.